Debt is a reality for many of us, and it's a topic that can be confusing and overwhelming. It's important to understand the truth about debt so that we can make informed decisions about our finances. First and foremost, it's important to understand that debt is not inherently good or bad. It's a tool that can be used to achieve financial goals, but it can also lead to financial strain and stress. The key to managing debt is to use it responsibly. Debt is not something to be feared or avoided at all costs, but rather it's something that should be approached with caution and intention. It's important to understand that debt is a necessary part of our financial landscape. It can help us to achieve our goals and aspirations such as buying a home, starting a business, or investing in an education. However, it's also important to be aware of the potential downsides of debt, such as high interest rates, and the risk of financial difficulty if not managed properly. The key to managing debt is to use it responsibly. This means having a clear plan for repayment and making sure that the debt is for a worthwhile investment or purchase. It's also important to not overextend oneself, as having too much debt can lead to financial stress and difficulty. One of the truths about debt is that it can be a double-edged sword. On one hand, debt can help us achieve our dreams and aspirations, such as buying a home, starting a business, or investing in an education. It can give us access to opportunities and experiences that we might not have been able to afford otherwise. In addition, using debt to invest in assets that appreciate in value, such as property, can be a good long-term financial strategy. On the other hand, too much debt can lead to financial difficulty and stress. High levels of debt can make it difficult to meet monthly payments and can negatively impact credit scores. This can lead to a cycle of financial difficulty where high interest debt makes it difficult to get out of debt. Additionally, high levels of debt can limit your options and ability to make future investments or purchases. Furthermore, high levels of debt can also cause a lot of emotional stress, as it can be overwhelming to manage multiple payments and keep track of interest rates and due dates. It can also affect one's mental and physical well-being, leading to sleepless nights, depression, and anxiety. Investing in property can be a great way to use debt effectively. When you take out a mortgage to purchase a rental property, the rent you collect can be used to pay off the mortgage, and you might even be able to generate a positive cash flow from the property. As the property appreciates in value over time, you can also potentially sell it for a profit. By using debt to invest in property, you can leverage the money you have to potentially make a larger return on investment. Additionally, owning rental property can also provide tax benefits, such as the ability to deduct mortgage interest and depreciation from your taxes. However, it's worth noting that investing in property comes with its own set of risks, such as fluctuations in the real estate market and the potential for vacancies or difficult tenants. It is important to thoroughly research the market and the property before making a purchase, and to have a plan in place for managing the property and generating income. Additionally, it's also important to have a plan to pay off the mortgage and a cash reserve to cover any unexpected expenses. Another way to use debt is investing with debt, also known as leverage. This involves using borrowed money to invest in assets that have the potential to generate income or appreciate in value. The idea is that the return on the investment will be higher than the cost of borrowing, allowing you to earn a larger profit. Using leverage to invest can amplify both the potential gains and losses of an investment. For example, if you invest in a stock using leverage and the stock price goes up, your return on investment will be higher than if you had invested without leverage. However, if the stock price goes down, your losses will also be amplified. There are several ways to invest with debt, including 1. Margin trading. This is when you borrow money from a brokerage to buy stocks or other securities. The securities you purchase act as collateral for the loan. 2. Real estate investment trusts, REITs. These are investments in real estate that allow investors to purchase shares in a trust that owns and manages properties. REITs often use leverage to purchase properties. 3. Options trading. This is when you use leverage to buy options contracts, which give you the right to buy or sell an underlying asset at a certain price at a certain time. 4. Leverage ETF. These are exchange-traded funds that use leverage to amplify the returns of the underlying assets. It's important to note that investing with debt can be risky, especially if you do not have a solid understanding of the underlying assets and the market conditions. It's always a good idea to consult a financial advisor before making any investment decisions, especially if you're planning on using leverage. Additionally, it's important to have a plan in place to manage the debt and to pay off the loans. It's also important to keep in mind that the investment can underperform, and the debt still needs to be repaid. Therefore, one should be prepared for the worst-case scenario and not put all the eggs in one basket. In our opinion, we would certainly not recommend using debt to invest in a business. Can be an effective way to grow a company and increase its value. Debt financing allows a business to raise money quickly and can be a good option when the business is not yet profitable or does not have enough assets to secure a loan. There are several types of debt that a business can use to invest, including 1. Bank loans. A business can borrow money from a bank to invest in equipment, property, or inventory. The loan is typically secured by the assets being purchased, and the business is responsible for repaying the loan with interest. 2. Business credit cards. A business can use credit cards to make purchases for the company, such as buying inventory or equipment. Credit card debt is typically unsecured, which means the business does not have to provide collateral to secure the loan. 3. Lines of credit. A line of credit is a type of loan that allows a business to borrow money as needed. The business only pays interest on the amount of money it borrows, not the full credit limit. 4. Business loans from alternative lenders. These are loans from lenders other than banks, such as online lenders or peer-to-peer lenders. They can provide funding quickly, but often have higher interest rates than traditional bank loans. 5. Angel investors and venture capital. Businesses that are in the early stages of growth can also raise capital by selling equity in the company to angel investors or venture capitalists. Using debt to invest in a business can help the company grow and increase its value, but it also comes with risks. The business must be able to generate enough revenue to repay the loan, and the business may be at risk if the investment does not perform as expected. It is important to have a solid business plan and to carefully consider the terms of the loan before taking on debt. Additionally, it's important to have a plan in place to pay off the loan and manage the debt. Thank you for watching our video on using debt effectively. We hope that you found the information helpful and that you now have a better understanding of how debt can be used to invest in assets that generate income or appreciate in value. Remember that while debt can be a powerful tool, it's important to use it responsibly and to have a clear plan for repayment. If you have any questions or comments, please leave them in the comments section below and we'll be happy to respond. Don't forget to like and subscribe for more videos on personal finance and investing. Thanks for watching.